$5 trillion vanished in 30 months. Not from a war, not from a natural disaster, from websites that barely made money selling dog food, groceries, and banner ads. How did an economy built on pets, sock puppets, and clicks manage to vaporize more wealth than some nations will produce in a century? And why do the numbers suddenly look uncomfortably familiar in the age of artificial intelligence? Picture the end of the 1990s. The NASDAQ has just climbed 600% in 5 years. Stocks with no profits are worth more than industrial giants. Analysts on TV insist the old rules of business are dead. If almost no one was making money, who actually had the money? What invisible debt was building behind the scenes? And what black swan moment finally shattered the belief that the internet had abolished gravity? Stay with this story, and you'll see the rise and fall of the dot-com bubble through 3 lenses. First, the characters. A sock puppet that burned $300 million, a grocery startup that spent $1 billion on warehouses no one needed, and Wall Street prophets who replaced profit with eyeballs as currency. Second, the mechanics. How cheap money, fake metrics, and suicidal burn rates created an invisible pile of obligations that could never be paid back. Third, the echo. Why today's AI spending spree, $400 billion a year on data centers and chips, looks eerily like 1999, and where the similarities stop. By the end, you'll know who had the money, what debt was quietly accumulating, and the precise moment trust died. Let's rewind. In 1995, the internet feels like magic. You type a few characters, the modem screeches, pages crawl onto the screen, and everyone agrees, this is the future. After a hedge fund named Long-Term Capital Management nearly implodes the financial system in 1998, the Federal Reserve slashes interest rates. Money gets cheap, then Congress cuts capital gains taxes in 1997. Gambling on risky tech stocks doesn't just feel exciting, it feels smart. Cheap money, lower taxes, and a technology that promises to rewrite everything. The conditions for a mania are in place. Wall Street gives it a name, the new economy. In this story, profits belong to the old economy. The new economy runs on eyeballs and mindshare. If millions of people visit your website, someday you'll monetize them. The numbers become unhinged. By late 1999, tech stocks on the NASDAQ trade at about 200 times earnings. Historically, 15 to 20 is normal. Even Japan's notorious late 80s bubble peaked around 80. One index of internet stocks rises 1,000% in a few years. CNBC covers daily market moves like a sports channel. People quit their jobs to day trade from their bedrooms. Here's where the money sits. In inflated stock prices and venture capital funds. Investment banks collect huge IPO fees, pushing any company with .com in its name onto public markets. Venture firms spray billions into money-losing startups. But the underlying business math is absurd. Think about customer acquisition. If you spend $150 in ads to acquire a customer who will only ever give you $30 of gross profit, growth doesn't save you. Scale just multiplies the loss. Yet founders boast about how fast they're burning cash. Burn rate becomes a status symbol. A startup's lifespan is measured in months of runway before the next funding round. The market celebrates this. Analysts tell viewers to rethink the outdated idea that companies should make money. A new logic takes hold. Get big fast, dominate the category, figure out profits later. No company embodies this more perfectly than Pets.com. In early 1999, Pets.com launches with a simple idea. Sell pet supplies online, letting Americans who love their animals get dog food delivered to their door. But pet food is heavy and cheap. You earn small margins per bag, but shipping it across the country costs real money. Every order risks turning into a loss once you pay UPS. Pets.com raises tens of millions anyway. Venture capitalists are thrilled. They push the company to saturate the market with its brand. Enter the mascot. A hand puppet dog with big eyes and a microphone becomes the face of the company. The sock puppet appears on talk shows. It has its own merchandise. It rides a float in the Macy's Thanksgiving Day Parade. In January 2000, Pets.com spends about $1.2 million on a Super Bowl commercial. For the year, it shells out roughly $42 million on advertising and brings in about $619,000 in revenue. $70 of marketing for every $1 of sales. The company often sells dog food below cost just to attract customers. Every sale is a small act of self-destruction disguised as growth. Yet in February 2000, Pets.com still raises $82.5 million in its IPO, valuing the business at almost $300 million. It has no profits, no path to profits, and a business model that gets worse with scale. But it has two things investors crave: a.com and a story. So who really has the money? Mostly the early investors and bankers who sell at the IPO and collect fees, while the company races to burn what's left. The hidden debt building up isn't always literal loans. It's promises that one day profits will justify these valuations, that one day the economics will flip from red to black. Those promises, not written on any balance sheet, are the invisible debt of a bubble. If Pets.com is the cartoon version of this story, Webvan is the hyper-real one. Webvan wants to reinvent grocery shopping. Order online, get your food delivered. Investors fall in love. Webvan raises around $1.2 billion. Instead of proving the model in one city, the company leaps straight to scale. Executives sign a deal with construction giant Bechtel to build 26 automated warehouses at about $35 million each. Conveyor belts, robots, custom software. Nearly $1 billion goes into infrastructure before the business model works in even one zip code. Then the operating numbers start coming in. An average order is about $91. Grocery margins run around 25%. So on each order, Webvan might make about $23 in gross profit before paying for drivers, fuel, maintenance, overhead in those billion-dollar warehouses. Delivery costs, around $150 to $160 per driver hour. Drivers manage fewer than 2 deliveries per hour. Spread that cost out, and delivery alone eats more than the entire profit from the food. To break even, customers would need to order hundreds of dollars of groceries at a time. They don't. They order like normal families, 50, 70, 90 bucks. Webvan burns about $125 million every quarter. Nearly $500 million a year. The more it grows, the faster the cash disappears. Here the debt is physical. Those warehouses lock in massive sunk costs that only make sense if years of profitable sales follow. They never do. Construction firms get paid. Engineers and consultants earn their fees. Venture capitalists sometimes sell shares into the IPO. Banks get underwriting fees. Meanwhile, Webvan's operations are structurally unprofitable. By July 2001, Webvan is bankrupt. At the time, it's the largest failure in venture capital history. While these corporate bonfires burn, the market climbs higher. On January 10, 2000, the ultimate symbol of confidence appears. AOL announces it will merge with Time Warner in a roughly $350 billion deal, the biggest corporate marriage America has ever seen. AOL sells dial-up internet access and online ads. Time Warner owns magazines, movie studios, and cable networks. Steady, old-school cash flow. But thanks to the mania, AOL's stock market value is roughly double Time Warner's. The message is clear: the future is digital, and traditional media better submit. AOL's CEO declares that new media has come of age. Time Warner's chief talks about unleashing unprecedented possibilities. The old media empire agrees to be paid mostly in AOL stock, trusting those inflated shares as real currency. This is late-stage bubble logic. A company whose main product, dial-up access, is already on the verge of obsolescence, uses its overheated stock to buy a more stable business? On paper, both sides win. In reality, they've locked themselves into valuations that assume the good times will last forever. 2 months later, time runs out. On Friday, March 10, 2000, the Nasdaq touches 5,048.62. Intraday, it pushes even higher. But something odd happens. The market can't hold the gains. Selling pressure appears. The index closes nearly flat. Smart money is sneaking out while the crowd still cheers. Within days, the cracks widen. On March 20th, Barron's publishes a cover story with a blunt title, Burning Up. The imagery is literal. Money bags on fire. Inside, journalist Jack Willoughby does something almost childishly simple. He takes 207 internet companies. He looks at how much cash they have. He looks at how fast they're burning it. Then he divides. How many months until they run out? The answer is terrifying. 51 of them will be broke within a year if nothing changes. DrCoop.com has barely 6 weeks of cash. eToys has a few months. Pets.com, less than 10. The invisible debt of the bubble, those promises that cash will always be there, suddenly becomes visible. In a single chart, it turns from vague optimism into a countdown clock. That same day, another shoe drops. A software company called MicroStrategy announces it's been too aggressive with its accounting. It will restate earnings. The stock loses about 62% in one day. If profits can be faked and cash is running out, what exactly are investors buying? This is the black swan for trust, not a meteor from nowhere, but a sudden public collapse of confidence. The math that everyone ignored is now printed on the front page. From there, the fall accelerates. Over the next 6 weeks, the Nasdaq drops 36%. In mid-April, it falls 25% in a single week, including a one-day plunge of 9%. That's worse than the legendary Black Monday crash of 1987. Day traders who quit their jobs to play the market watched their screens turn red. Many bought on margin, using borrowed money. As prices sink, brokers issue margin calls, demanding cash the traders don't have. Accounts are liquidated automatically. Some investors end up owing money beyond what they started with. Stories appear of families losing life savings in days. Some never return to the stock market. Behind the scenes, the flow of money reverses. IPOs halt. Venture funds grow cautious. The spigot of easy cash that fed Pets.com, Webvan, and thousands of others turns off. Remember the question, who had the money? Banks and underwriters already took their cut. Construction firms were paid. Early insiders who sold stock at the top walked away with fortunes. Billion-dollar founders who hedged their shares, like Mark Cuban, locked in their gains with clever option strategies. What's left are small investors, employees paid in options, and late-stage backers holding stock certificates rapidly approaching zero. Between March 2000 and October 2002, the Nasdaq falls about 78%, from over 5,000 to around 139. Roughly $5 trillion in market value evaporates. More than 4,800 internet companies are acquired under distress or simply shut down. Names like Pets.com, Webvan, eToys, Cosmo, Boo.com, and MP3.com vanish. Hundreds of thousands lose jobs. The Nasdaq doesn't fully recover its 2000 peak until April 2015. 15 years to break even. Yet out of the wreckage, some names survive. Amazon almost runs out of cash but raises debt just in time. eBay thrives because its auction model actually prints money. Google, barely a startup during the peak, discovers a brutally effective business, targeted advertising tied to search. These survivors share one trait. At some point, their unit economics make sense. Customers pay more than it costs to serve them. The math eventually works. The bubble was real, so was the technology. Now fast forward. Today, the new craze is artificial intelligence. In a single year, companies pour an estimated $400 billion into AI infrastructure. Data centers, chips, cooling systems, networking gear. Microsoft, Google, Amazon, Meta, Apple, and others race to build massive AI factories worldwide. On the surface, this looks safer than 1999. These firms are hugely profitable. They fund spending from cash flow, not junk bonds. Their stocks trade at 25 to 30 times earnings, not 200. But look at the ratio that mattered in 2000. Investment versus actual revenue. Analysts estimate that AI services today generate maybe $20 to $40 billion in yearly revenue. That's a tenth of what's being spent on the hardware to support them. Depreciation alone, the way accountants spread the cost of those data centers over their useful life, could hit $40 billion a year from just 1 year of investment. To give shareholders a normal return, the industry might need $160 to $400 billion in annual AI revenue. We're nowhere near that, okay? Enterprise surveys suggest that roughly 90% of corporate AI pilots produce zero measurable return on investment. Companies roll out pilots and proofs of concept, but the profits are thin. Meanwhile, one of the most visible AI firms pulls in billions in revenue, but spends even more. Its projected cumulative losses over years run into tens of billions. Valuation estimates soar into the hundreds of billions, echoing the eyeballs first, profits later logic of 1999. Infrastructure providers feel the strain too. Reports surface of large, reputable firms losing substantial sums on AI-related data center leases. If the most disciplined operators struggle to break even on AI hosting, what does that say about everyone else? Once again, ask, who has the money? Chip makers like NVIDIA sell out of hardware with extraordinary margins. Construction companies win contracts to build campuses of servers. Cloud giants lock in long-term power deals. Consultants bill for AI strategy work. The invisible debt, a mountain of expectation that future AI software, apps, and automation will justify today's build-out. That users will pay enough to cover not only operating costs, but the capital sunk into servers and energy. If that demand doesn't arrive on schedule, we face a new kind of overbuild. In 2002, telecom firms were left with dark fiber, unused cables in the ground. Today, we could end up with idle GPUs, racks of high-end chips sitting underused, consuming power and bleeding value. There is one crucial difference from 2000. Back then, thousands of fragile startups carried the risk. When the market turned, they died overnight. Now the biggest AI spenders are some of the richest companies in history. They can subsidize losses for years, maybe decades. That doesn't eliminate risk. It moves it. Instead of a sudden wave of bankruptcies, the danger is a slow grind. Lower profit margins, declining returns, and a painful reset in valuations. And there's still the possibility of a trigger. In 2000, the Barron's article and MicroStrategy's accounting scandal served as a psychological turning point. Suddenly, everyone realized the math didn't work. In an AI bust, the equivalent could be a major player admitting its AI investments won't pay off, a regulatory shock, or a recession that makes investors demand cash today instead of promises tomorrow. So what did we learn from the dot-com crash? We learned that innovation can be real while its valuations are fantasy. The internet did change everything, just not as fast and not in the ways 1999's prices implied. We learned that fake currencies, eyeballs, and clicks can hide simple truths. If it costs you more to serve a customer than you'll ever earn back, growth is just a magic trick. We learned who really holds the money in a bubble. It flows first to those who sell picks and shovels, underwrite deals, and exit early. Everyone else is left holding the story. Most of all, we learned that the invisible debt of belief, the conviction that this time is different, always comes due. There is a point where investors ask the boring question again, what's the profit? On March 10, 2000, the market hit that point. Over the next 31 months, $5 trillion in misplaced confidence was marked down to reality. Today, as we rush into an age of AI, the stakes are even higher. The technology is more powerful. The sums involved are larger. The players are stronger. but the math is still the math. If we remember Pets.com and Webvan, if we remember the sock puppet and the billion-dollar warehouses that never paid for themselves, we can see the pattern before it peaks. Who has the money? Where is invisible debt of capital and expectations building up? And what event might finally force everyone to open the spreadsheets instead of the slide decks? History doesn't repeat exactly, but it does leave very clear warnings. The dot-com crash was one of them. The question now is whether we're listening.